everyone. This is Dr. Jack Nordhaus of Insurance Marketing and Management Services and the Inside Track. And our topic today is Agency Valuation 101, and we're happy to be speaking with Al Diamond of Agency Consulting Group, who has probably done more of these than anybody, I would think. Yes, Al, is that a fair statement? Or you?
Well, I would guess so by now. We've been doing them for about 30 years, and the minimum we do is several hundred a year.
Wow.
When in our really good years, we'll do up to 1,000 of them.
So you know whereof you speak. Okay.
I think so.
I think so. Well, let's just do a little intro here. Here I am, 33 years. Just, I guess you and I have been at it for about the same length of time in our.
Yeah, but I look a lot younger.
Well, that's true. You have more hair. But
I don't know about that.
Well, you should see. Anyway, and here is your capsule bio, and it's a pretty darn impressive, I would say. And today we're going to be, our last webinar we spoke about acquisitions and mergers, but obviously valuing an agency really plays a key role, so that's what we're going to talk about today. So how much is an agency worth?
Well, that's the question every agent wants to know. And if I tell you I get one phone call a week from agents asking me, listen, I don't need a full valuation. If you can just give me the current multiple, that's all I really need. If I get one, I get 15 a week.
Yep. From
agents who believe that there is a magic multiple of something that could properly define their agency. And obviously, that's not how agency values work. It never has been, although that's how people have done it sometimes in the past. And we've got to start out with how to define value. An insurance business is really worth at most what you, if you're the owner of the business, or with someone else who's valuing your business, or you valuing somebody else's business, what they could achieve in earnings for operating that business over a specific reasonable period of time. In other words, if I can make $1 million out of your agency and I want to buy your agency, then reasonably I can pay you as much as $1 million and basically make nothing during the period of that payout and then be enriched thereafter. And that's how value is determined. However, the fair market value of a business, as defined by the IRS and all the pundits, is really what a willing buyer and willing seller agree to that will cause an agency to change ownership in a merger, acquisition, or other form of association. That basically is the definition of the term fair market value. However, the value of an agency and the price of an agency is different, as most agents who have bought or sold or merged agencies will attest to. Let's talk for a minute about the price versus the value. The price of a business is negotiated between the buyer and the seller, taking into account abnormal risks or abnormal rewards to the buyer or seller that could enhance the value of a business or could discount it. Below the stated value, the earnings potential of that business. So now you know what the definition of the value of business and what the definition of the price of a business could be.
Okay.
There are many agents who are buying, selling, merging, or not the ones valuing internally for themselves, who are looking at asset sales versus stock sales, and they're confused by what it means. A stock sale is basically a corporate sale. You're buying the entire corporation. The name, the assets, the liabilities, everything within the corporation, you're buying the stock of the corporation. It's sometimes appropriate in an internal perpetuation scenario where one generation sells down to another. It might not be, and we'll cover this a little bit later, it might not be appropriate in most of the current acquisitions that are being done. However, it might very well be the appropriate way of valuing the agencies in a merger situation. In a stock sale, we're buying the liabilities as well as the assets. So any buyer or seller has to be very careful. If it's a cash-rich agency, you're basically selling dollar for dollar the cash in your agency. However, on the other side of it, if there are a lot of liabilities in the agency, you're picking up the old owner's liabilities, and that's something that you may or may not be willing to do based on the types of liabilities there are.
Okay, makes sense.
I think we may have missed one there.
Oh, let's
go back.
Yeah.
That's versus the asset sales. In the asset sale, you're actually purchasing the book of business, and you can also purchase other specific assets, things like names, the goodwill, the telephone number. You can purchase that, but leave the corporation in the hands of the original owners. That's a way of achieving that acquisition of the agency without taking corporate liabilities if that's not the most appropriate way for you. Now, can you do it yourself, or do you need a specialist? Well, first question I can answer quickly. Can you do it yourself? Absolutely. There are many, many simple sales where they're small agencies usually. They're sole proprietors, where the only thing they have might be the book of business, and that could be determined quite easily if you value the agency properly. Now, the question is, should you do it yourself? And that's a little bit more complicated because the answer is probably not. There are so many variables in agency sales, mergers, and values either internally or for estate planning purposes that you might be wise to have a professional do your valuations and potentially negotiate the deals as well. Now, the third question, and the most important one, is whether you do it yourself or have a professional do it, should you understand the technical aspects of valuing agencies? And the answer is absolutely. You would never consider doing other forms of deals based on an expert's opinion without understanding the derivation of those numbers. So if you have an agency valuer, as an example, who writes you a letter and says the value of your agency is $550,000 and doesn't back that up with all the substantiation on how they got there, they're not doing you any favors, and you can't be sure that that number is correct. It should be, everything there should be backed up.
Okay.
Now, the basis of agency values is an IRS revenue rulings, ruling 5960. It's the genesis. It defines the valuation of businesses in 8 factors. And what we're considering is, and this is what every valuer should consider, whether you're doing it yourself or using a professional, the nature of the business and the history, the economic outlook in general, and the condition of the economy of, in our case, the insurance industry, the book value of the stock and the financial condition of the business if you're buying the corporation. That book value is the tangible net worth of the agency. And that's calculated through the balance sheet and easily calculated as well. Number 4, IRS says one of the main considerations is the earning capacity of the company. That's why all of us who are knowledgeable and do a lot of valuations will tell you that the basis of the value is not a multiple of anything. It's how much you could earn by buying or selling or merging or valuing that agency.
Okay.
Continuing with the other 4 parts of the rules, the dividend-paying capacity of the agency, how much earnings are available or have been available that can be paid out in dividends. Very important. Also, whether or not the enterprise has goodwill or intangible value. All insurance agencies are very rich, very heavy in intangible value. One of the things that owners considering buying, selling, merging, what have you, need to understand is that there is a hard and fast IRS rule that says that enterprise or goodwill value as an intangible for an insurance agency can only be depreciated or amortized over 15 years. Didn't used to be that way, but it has been for the last 10, 15 years. Number 7 is the historical sale of stock and the size of the block to be valued. In most agencies, that doesn't matter. The stock hasn't been sold historically. But where it has, where you've had partners buying in, buying out, that's one of the things we look at when we establish value. At what price did they buy in or buy out? When we value publicly held companies, this is one of the main issues that we consider. And of course, the market price of stocks of other corporations of similar quality, size, and dimension. Now, this is a very problematic issue in insurance agency valuations because some folks try to look at major brokerage house transactions and try to value small independent insurance agencies using the same market conditions and pricing. And you can't do that. It's like taking your local hamburger joint and saying because the McDonald's down the street was valued at X, this hamburger joint should be valued similarly. They're not the same. They sell the same product, but they're not the same. So with all this in mind, the question still arises in most agencies' minds, so what's my agency worth?
All right.
Come on, Al. Give me a quick one. Is it worth 1 time, 2 times, 3 times? And by the way, times what? The old rule of thumbs in our business has been varied. For instance, a multiple of revenue. 2 times commissions or 2 times revenue, or a multiple of earnings, 7, 8, 9 times earnings. In some cases now, the accounting heads are starting to use the term EBITDA. For those agents who aren't acquainted with it, no reason you should be. EBITDA is earnings before interest, taxes, depreciation, and amortization. It's just a derivation of earnings. Mm-hmm. Earnings is a derivation of commissions. Commissions is a derivation of revenue. And it's unfair to use any of these as a forward-looking method of valuing agencies. I call it valuation voodoo. If you take an agency that has $1 million of income and you value it appropriately, and the value of the agency is $1.5 million, you can always go backwards and say that the valuation of that particular agency was 1.5 times revenue. But that doesn't mean that the valuation of any other agency is 1.5 times revenue. Mm-hmm. It depends on the condition of the agency. What if the agency that we just valued was a growing, young, vibrant agency, and the agency you're looking at has nothing but 75-year-old clients, 75-year-old employees, retired owners, and hasn't grown in 10 years? Would you pay the same multiple? I don't think so. Looking at multiples as rules of thumb, or any rules of thumb, is like saying, why not just take $10,000 times the number of chairs in the agency? That wouldn't work for anyone. Anyone in their right mind would say, what does the number of chairs have to do with the value, any more than what does the revenue have to do with the value? It's just the top line. What happens if you earn no income from that revenue? You're a $1 million agency. You lose money every year for the last 10 years. How much is that agency really worth in your hands? It may be worth more to someone else. So now let's talk about the real value of an agency.
Okay, the good stuff.
The good stuff. The real value of an agency is its future earnings potential over some period of time, your decision, under the circumstances specific to the valuer. So if you are valuing your agency for estate planning purposes, for life insurance, and you're 45 years old and you're going to be in the agency for another 20 years, then it makes sense to take the historical trending of the agency in revenues, expenses, and earnings and carry them forward to define your value, because that's what you're doing and you intend to continue to do it. If your next-door neighbor is valuing your agency so that he can acquire it, and he can get rid of your building and get rid of your accountant because he already has one, and maybe you don't need two receptionists, and combine and consolidate some expenses, he may be able to earn quite a bit more than you do on the same book of business. And that means that his value for your agency is worth more than yours. And that's a common issue. So if the future earnings potential is so important, how do you figure out what future earnings are? Well, what you do is you review the historical trends of the agency on a line-by-line basis. You look at the revenues and you look at the expenses. And then you adjust those revenues and expenses for expected changes into the future if you know, if you can crystal ball the future. If not, if you think that there's no changes made, the economy will continue as is, everything will trend forward, then you trend your revenues forward and your expenses forward in the same manner. To that number, you must also calculate risk factors for discounting.
Okay.
Risk factors is a very complex question. We use, when we do our valuations, some 200 or more risk factors that are covered in our discussions with the agent and our questionnaires, which I'd be happy, by the way, to send out to anyone listening or watching this webinar. It's their Bible on what to ask for if they're looking to value someone's agency.
200.
I'm sorry?
200. That's incredible.
Oh, at least. In some cases, it's more, because when we uncover certain risk factors, it opens itself up to others. There are other valuers outside of the insurance industry who tend to use stock prices and the values of similar companies to determine risk factors, and they do it very generally. We, on the other hand, believe that whether you do it yourself or you let someone else do it, you should be very, very specific, because every agency we've ever gone into has different risk exposures. So if two agencies side by side have the potential through their trends of generating $1 million worth of earnings, and one of them happens to insure nothing but the oil and gas industry, while the other agency has a very broad spectrum of large, medium, and small lines, commercial, personal, life and health, and all the other lines, then the one that only does one industry, or who may only have 5 or 10 clients, has a higher risk. And that risk discounts the value of the agency, or at least contributes to the value of the agency. So that's the calculation of risk factors. Finally, when you do all of that and you've trended out the future of the agency based on what you think the revenues, expenses are going to be, based and discounted them appropriately or added to them based on minimal or higher risk, then you have to determine how many years you're willing to give up your earnings in order to sponsor that agency. It doesn't make any sense at all to give up all the potential profits and earnings of the agency for the next 10 or 20 years in order to buy it. If you're doing that, you'll never make your money out of that agency. So most agents look for anywhere from a 3 to 4 or 5, and maybe as many as 6 or 7 year period of time that they're willing to give up their earnings, and that's going to determine what the total cost of the agency is going to be to them. Now, when we look at historical trends in revenues, we're looking at several major categories. They may call them different things, but they're always there. P&C commissions, contingencies, life and health and all employee benefits incomes, and then your outside income, the non-operating income like investments, fees may be operating or not, and any other income that comes into the agency. Those are the categories that we look at in historical trends of revenues. On the other hand, when we look at historical trends of expenses, there are about 20 major lines of expenses. They're split into 4 primary categories. The first one is compensation. The compensation category is split into executive, management, sales, and office, and then finally the cost of employment, which are the benefits, payroll taxes, contributions to pension plans, things that are common to that agency or will be so after any acquisition, merger, and so on. The other categories that we look at are sales expenses, operating expenses, and administrative expenses. The difference between operating and administrative is operating has to do with the continuous operation of the agency. Administrative are things outside the operation that you would have whether the agency was operating or not. Bank charges, interest expense, things like that.
Okay.
So now we've taken the historical trends of revenue and the historical trends of expenses, and the next thing I said you have to do is you've got to adjust them. You've got to look at every line of revenue and expense and their trends to build a pro forma view of future income and expenses at least 5 years into the future. More if you expect to pay for it over a longer period of time. We adjust every single line by either known or accepted changes with a single exception. Don't bet on the come. For instance, we run into this a lot where an agent says, this agency that I'm looking at is virgin for life and health. They've never penetrated life and health. They've only done P&C. So I can expect to sell 5% of the client's life and health, and I can project income. Don't bet on a circumstance that you have not yet encountered within that agency. For instance, the agency may have had a deal with another life insurance agent somewhere down the road who's completely penetrated the agency. It just doesn't show up on their revenues.
Okay.
So only bet on the things that you know about that agency because of its historic perspective. Now we've done the revenue trending, the historical expense trending. We've done adjustments. Now, here are some of the risk factors. As I said, some of the non-insurance valuers, and there are many out there who are qualified valuers but not in our industry, tend to look at the time value of money as one of the only risk factors available. We look at the time value of money as one, but not the only risk factor. The time value of money is what your money is going to be worth 1 year, 2 year, 5 years from now. And that basically is built on the 10-year T-bill rate, which is published every week. And you can get it every day if you want. So that's a fixed number. However, the others aren't. These are judgments that depend on your knowledge of the insurance industry. So practically, if you're not in the insurance business, don't be valuing an insurance agency if you're going to buy it or for someone else. Because you have to look at the carriers and you have to say, what are the risk factors associated with the carriers that are within that agency, as an example. We look at client risk factors. Are our clients old? Are our clients tied to the current owner of the agency? Is it all family business? Do we have single major clients instead of a multitude of smaller ones? It changes the risk factors. We also look at staffing. Same thing. If we have an agent who has had the same employee base for the last 30 years, they're probably around the same age as the retiring owner, and they may be retiring quicker than you think once you take over the business. So those are staffing risk factors, the quality of the staff, the knowledge base of the staff. These are things that have to be determined by you. All of those fit into our couple of hundred risk factors that we judge, and it creates a subjective discount rate. That discount rate applies against the raw earnings potential to come up with a value of the agency over some period of time. However, that's when you have to determine how long are you willing to wait for your piece of the rock. The value to you is equal to the discounted earnings potential for as long as you're willing to wait to earn your full share of profit. And there may be reasons for waiting a long time. I've handled cases where we've had one agency buying out its only competitor in the town. If they didn't buy him, some other agent was going to come in. They were willing to wait a long time. They were willing to overpay for the value of that agency to keep competition from coming in and starting afresh.
Okay.
So,
Wow.
as you can tell, while this is a very interesting concept and something that every agent should know, it's not one that they cover frequently or worry about on a day-to-day basis. That's why there are folks like us out there. If you need any assistance, by all means, please give us a call or email us or find us through Jack. Jack, I know you have other experts as well that are equally qualified to do this kind of work. And if you would like one of our questionnaires, something that you can use yourself for valuing your business or any other business, we'd be more than happy to share it with you because you're associated with Mr. Nordhaus.
All right. Well, that is just fantastic, and you've said so much in 25 minutes. It's as the head spins, and this has got to be one of our best. I mean, just this has to be, and I want to thank you on behalf of our members, Al, and anybody who watches or listens to this presentation. You really summed it up beautifully, and I want to thank you again.
Okay. Well, it's my pleasure anytime.
All right.